Hello, folks. It's just 1 o'clock there, so I think we'll try and get going. Hello to everyone that's here, and you're all very welcome. Just to go over some housekeeping issues to start. When you join the chat room, as in the message I sent out this morning, your camera and your mic will be defaulted to off. Just leave it that way, as this is set up as a meeting as opposed to a webinar. So they'll default off. Just leave them that way, otherwise you'll be interrupting Jim's presentation. Jim will give his presentation, and afterwards, when it's over, you can type your questions into the chat box, and I'll relay those questions over to Jim, and we'll try and get us through as many as we can, depending on how they go. But for now, over to Jim. Good afternoon, Jim.
Hi, good afternoon, Daniel. Good afternoon, folks. I'd first of all just like to thank Daniel for organising this today, and for Sophie Carey and for Bart and the others here in the e-learning centre in Quinn for facilitating it. I suppose a special welcome to all of my own MBA students, the full-time. I hope you're doing well and that you're not finding the current situation too disruptive. What I want to do today, I really want to talk you through, I suppose, some of the big economic issues around COVID-19 and what it might lead to. So I'm going to start off by looking at where the global economy was prior to COVID-19. I sit down every January and take a look at the year ahead, and I'll just talk you through what I was thinking in January of this year. I want to talk about the global economic impact of COVID-19, what we've seen to date, and I suppose more importantly, what the future might hold. I want to focus in on what's been happening on financial markets, because there's been, absolutely dramatic movements in financial markets over the last few weeks. I'll take you through some of the official policy response we've seen in some of the major economies around the world. And then I want to, I suppose, take a little look forward as to what further policy response will be required, because believe me, we've seen nothing yet, and I think the response is going to have to ramp up significantly everywhere. And then I want to get a little bit parochial by talking about the impact on the Irish economy, how the Irish have responded to date, and I suppose most importantly also what is required. And at the end then, I just want to sort of think a little bit about the longer term economic and political legacy of this shock. So that's broadly what I want to cover over the next 45 minutes or so, and then there will be 15 minutes or so at the end for questions, which Daniel will handle, as he's said. If you think back, my full-time MBA students, if you think back to the first lecture I gave you last September, where I basically pointed out that the economic forecasting is fundamentally a waste of time, because forecasting the future is virtually impossible. Nevertheless, we as economists, we have to do it. As business leaders, we have to do it. It is necessary to have some sort of a view on the future. But economic forecasting is incredibly hazardous, because I remember using a slightly different term in class, which I'm not going to use online because this is being recorded. But the point is that stuff happens. And when stuff happens, it blows one's best forecasts out of the water. Coming into 2020, as I sat down in the early days of January to look at what the coming year might hold, 2019 was the year of slowest growth since 2007, 2008. So it was a somewhat challenging year. We didn't see a recession, but we certainly saw a period of very, very subdued growth and economic slowdown in most of the major economies. And statistically, 2019 delivered the slowest rate of economic growth since the great financial crisis in 2007, 2008. And a lot of the negativity around 2019 was driven by political events. We have Trump's trade war with China, and for students of English grammar in there, there is, that should be apostrophe S, but anyway, Trump's trade war with China. We saw a tit-for-tat trade dispute break out over the last 18 months. We saw the imposition of tariffs on trade in both directions. And I think the magnitude of the tariffs that were imposed wasn't really the issue. The big issue was that trade war, the growth of protectionism, was really rowing back what has been driving the global economy and global economic orthodoxy for 50 years. That is globalization. So I think a lot of businesses around the world were wondering if this whole globalized free trade environment and agenda was going to be fundamentally turned around. So it definitely had a very significant impact on business sentiment and investment around the world, as well as the direct effect it had on trade between China and the United States. Then we had Brexit, of course, since June 2016. Brexit has been an intensely political and pretty illogical situation. But we saw during 2019, it had a significant impact on the UK economy because a lot of business investment, a lot of consumer activity was basically paralyzed by uncertainty. And of course, in some of the Northern European economies like the Netherlands, Germany, France, that do a lot of trade with the UK, it had an impact there. The Euro area was probably the economic bloc that was experiencing most difficulty last year. The economy, having performed very well in 2017 into 2018, lost a lot of momentum as 2018 progressed and as we moved through 2019. And, undoubtedly, the Euro area has a lot of structural growth issues. The fiscal rules, they are a serious impediment to what governments can do in terms of fiscal policy. We have an aging demographic in countries like Germany, Italy, France, which does tend to sap economic dynamism. And then, of course, there is the whole issue about regulation in the Eurozone, and the UK perspective during the whole Brexit debate, etc., was the fact that the EU had way too much regulation, that it was sort of anti-business, etc., etc. But whatever the reasons are, there's no doubt about it. The Euro area has seriously displayed structural growth issues over the last few years. So in a nutshell, that's what the world looked like in 2019. Coming into 2020, I was certainly a little bit more upbeat on what the year ahead held. And it was really based on one premise. Excuse me. Donald Trump faces a presidential election in November. And the one thing Trump did not want going into that election was a US economy in trouble and a global economy in trouble because of a trade war with China. So I always believed Trump, as the pragmatic politician, would start to dissipate the trade dispute with China. And that's exactly what we saw happening over the last 3 or 4 months. We saw the reduction and the removal of some tariffs, and certainly there was a lot more conciliatory vibes flowing in both directions, which is exactly what Trump would require going into a presidential election. I would have warned also that once the presidential election was out of the way, that when we went into 2021, the likelihood is that those trade issues would re-emerge because, Trump is fundamentally determined to have a serious restructuring of the various trade agreements between China and the United States, between the United States and the European Union. So, but for 2020, the presidential election superseded everything else. So, hence, I was reasonably upbeat about 2020, not dramatically so, but I felt it would be a better year. And also the fact that in the UK, a hard Brexit was avoided on the 31st of January. A lot of that business investment that was on hold, it will be released like a coiled spring. So a bit of a rebound in the UK economy. But then, of course, over the last 3 or 4 weeks, COVID-19 has blown all of that out of the water. And I think if there's one thing we should learn, events like COVID-19, which is pretty dramatic, but it just demonstrates the hazards of economic forecasting. And unfortunately for business, not having a clear idea on what the future is going to look like is a serious problem. But anyway, that's the global economy coming into COVID-19. And I suppose the overriding theme there was that the global economy actually was quite vulnerable coming in. So when something that's quite vulnerable gets hit with a shock of the magnitude of COVID-19, well, clearly the economic implications of that are pretty dramatic and pretty serious. This was the IMF's, the International Monetary Fund's global forecast that was published in the middle of the Davos conference at the end of January. So it was pre-COVID-19, but basically what the IMF was looking at in 2020, 2021 was a gradual improvement in global economic growth. And I say gradual rather than dramatic. And a lot of this was really, particularly for 2020, was predicated on that view that the trade dispute between the US and China would dissipate in the run-up to the presidential election in November. But anyway, that was pre-COVID-19. And I suppose before I talk more specifically about the implications of COVID-19 and what we've seen to date, this was a presentation I did towards the end of February, and I had a slide, what to watch in 2020. I had Brexit, high up on the agenda because, and I will talk about Brexit a little bit later on because I think it is still an important issue, but I was highlighting Brexit uncertainty. I was highlighting growth in the global economy, particularly the Eurozone and the lack of growth momentum in that economic area. I was focusing in on the US presidential election and the impact and the implications of that for the trade dispute between China and the United States. I had, thankfully, COVID-19 in there in the middle of the slide, but certainly I did not have it top of the slide because at that stage, it definitely looked more like an issue that would have a regional rather than a global economic impact. I was looking at political developments around the world, and I suppose specifically the rise of extremist stroke populist politics around the world. And, some would argue that on February 8th, Ireland got its own version of the move towards more extreme populist politics with the pretty extraordinary general election result we got here. I would have looked at the changing of the guard at the European Central Bank and the European Union because Christine Lagarde took over the European Central Bank on the 1st of November. And on the 1st of January this year, Ursula von der Leyen took over as president of the EU Commission with a new cabinet, with a new 5-year agenda. And I was looking at, thinking about the implications of all of that. And I was also talking about, policy making in the European Union. I was posing the question, I've posed this question for some time, given how much monetary policy ammunition has been used around the world over the last few years with zero interest rates, with quantitative easing, and particularly in the euro area, is it now time that the fiscal rules should be significantly relaxed to try and allow governments stimulate economic activity across the European Union? So pre-COVID-19, that was definitely a debate that was starting in Brussels, and I think it would have ramped up in any event, regardless of what happened with COVID-19. But clearly, as I'll be saying in a few minutes, COVID-19 has totally changed the rules of engagement there, and very definitely the EU fiscal policy rules will have to be looked at. And then the final thing I would have highlighted for 2020, and this obviously is a short, medium and long-term issue. It's the implications of climate change, not alone on economic activity, but also on corporate behavior, particularly in areas like corporate social responsibility. But anyway, that's what I was highlighting as, in my view, would be the key issues in 2020. Obviously, all of that has changed over the last few weeks. We have effectively seen, starting in China and has subsequently spread to the rest of the world, we've basically seen the lockdown of economies. If you think about it at a very simplistic level, an economy is made up of all of those billions and trillions of transactions that take place every day. You buy a cup of coffee, you buy a newspaper, you buy a book, you get your hair done, Businesses invest in equipment, they make stuff, other businesses provide services. All of those billions and trillions of transactions are what makes an economy tick. And the real impact of COVID-19 has been that either due to voluntary or officially imposed restrictions, an awful lot of that economic activity has effectively died over the last couple of weeks. We're no longer seeing people flying, so airlines and air travel are in serious trouble. Tourism activity has ground to a total standstill. We have retailers around the world that have shut down. We've had banks shutting down. Here in Ireland this morning, Bank of Ireland announced the closure of 130 odd branches with immediate effect. We're seeing a lot of businesses work remotely. We've seen a lot of businesses shut down. If you look at tourism and the hospitality sector particularly, there's been a dramatic impact there. Retail likewise. So, effectively, all of those billions and trillions of economic transactions have died for the moment. And really the only areas we're seeing any real activity at this juncture is in the provision of public services, particularly health, law and order, and on the non-retail grocery sector, and also on the pharmaceutical side. Sorry, the retail grocery sector and the pharmaceutical side. So you'd have to think, and looks inevitable seems a total understatement at this juncture. Global recession looks absolutely inevitable at this juncture. And economists around the world are sort of falling over each other at the moment to try and determine the magnitude of that. And in fairness, it is impossible to determine the magnitude, but it's highly likely that economies like the United States will see a decline of anything from 10 to 20% in economic activity during the second quarter. And indeed, some of that will have hit at the end of the first quarter, because we're still in the first quarter. So you are looking at an absolutely dramatic decline in economic activity everywhere. And I think it could make the economic contraction we saw in 2007, 2008 with the great financial crash pale into insignificance. So global recession is absolutely inevitable. As I say, economic activity has effectively ground to a halt everywhere. And that, as I said, is due to a combination of official restrictions on activity, and also we've seen a lot of voluntary restrictions on activity. The decision from the Irish publicans to shut down at the beginning of last week, for example, is an example of that. And we are seeing that all over the world at the moment. And clearly, the main fallout from all of that is we are seeing absolutely massive job losses around the place. I mean, if you look at, for example, the non-grocery retail sector and also the accommodation food services sector here in Ireland, you could be looking at up to at least 300,000 jobs being lost in those sectors, and many others across the economy as well. And that's happening absolutely everywhere. There's a suggestion in the United States that the unemployment rate could jump to 20% of the labour force over the next couple of months. So massive job losses. The area that really stands out as being particularly badly hit at the moment is global travel and tourism has absolutely come to a shuddering halt. There's no doubt about that. We are seeing borders coming under increasing pressure. Last week, for example, we were seeing 60-kilometre tailbacks from trucks coming from Poland into Germany and vice versa. The borders are being closed up really to try and prevent the free movement of people, because people are the ones that spread this virus. So, that's why borders are tightening up quite significantly. But the problem is, and if you think about the single European market, if borders shut down or close up or tighten, the free movement of goods will become a more and more pressing issue. And that's why the EU is moving dramatically, quickly and aggressively at the moment to try and make sure that borders remain open, that we can continue to see the free movement of goods. Because if we don't, and we're already actually seeing some of this, supply chains are coming under pressure. Initially, 4 or 6 weeks ago, when Chinese industrial activity was shutting down, we started to see companies like Apple report difficulty in sourcing input for the iPhone and other Apple products from China. And we've seen that actually ramp up. So there is the supply chain issue from a part of the world that we now source a lot of stuff, which is China. But as closer to home, with borders tightening up, with the restriction of people, it's becoming more and more difficult to move stuff through borders in Europe. And that certainly affects the food supply chain as well as everything else. I suppose another impact is, where does Brexit go from here? And I'll talk more about Brexit in a second, because, as I said, I think it is still a very important issue. But there is an official view coming out of the United Kingdom that actually COVID-19 means nothing in terms of Brexit, and that the UK government's timetable will proceed as planned. I think that is an utterly bizarre perspective. I think it's an utterly bizarre view to take on this, but I'll elaborate a little bit more on that in a second. But have no doubt, COVID-19, will have a significant impact. I noticed a typo at the top of the slide. I've called it COVID 2019. That's a Freudian slip. I was putting these slides together very quickly last night, so you'll notice a few typos. I will correct them. Apologies. The other thing that I think has been clearly highlighted over the last few weeks, and I think this is a question I'll return to in my last slide about the longer term implications of this, but I think we've certainly seen highlighted the very precarious nature of modern capitalism, because we're finding that a lot of businesses, a lot of individuals, a lot of workers are actually living from week to week, and if a week breaks down, suddenly they find themselves in serious trouble. And I suppose a clear example of this is the part of the economy I work in, which is the gig economy. A lot of gig economy workers have discovered over the last couple of weeks that their jobs have dried up and they are now in serious difficulty. So, as I say, I just reiterate the point that the precarious nature of modern capitalism is certainly being exposed at the moment. And indeed, it was exposed again 10 years ago after the great financial crash. Not a lot happened subsequently, but I do think there will be a fundamental reevaluation of the world we live in once we come out of this particular crisis. Looking at the financial market impact, just to reiterate the last slide there, there's no doubt about it, COVID-19 will push the global economy into recession. And the only question is how long that is going to last. And clearly, the answer to that is medical and scientific rather than economic, because as long as economies are in lockdown, and we're now only beginning to see that process kicking in, and we're going to see a lot more economies locking down over the coming weeks, the longer they remain locked down, the longer the recession will be, and the longer the impact will be. The question is then, how quickly will global economic activity actually recover? There's a bit of me that thinks this is going to be a V-shaped economic cycle. If you look at the left-hand side of the V, a very, very sharp decline. And I would stress that we're nowhere close to the bottom of the V yet. We're still somewhere on the precipitous declining part of the V. But then once the virus starts to dissipate, once we see a leveling off in cases, and or we get more positive news on the development of a vaccine to deal with this, suddenly, a lot of that economic activity that has been put back on hold could actually re-emerge pretty quickly. Maybe that is being naively optimistic, and there are serious risks to it. But I'll touch on that a little bit later on to tell you, in my view, what I believe needs to happen at this stage. The financial market impact has been absolutely dramatic over the last few weeks. Equity markets have had an absolutely calamitous correction, and that is continuing this morning. When I left my office, all European markets were down anything from 2.5% to 5%. Red letters absolutely every place. Coming into COVID-19, global bond yields had fallen to the lowest level on record. The Irish government was able to borrow for 10 years at a rate of minus 0.2, the German government at minus 0.6, the Italian government at a rate of about 0.7%. So global bond yields, or the price at which governments can borrow money, had fallen very, very significantly. Then when COVID-19 started to over the last couple of weeks, as the implications start to become more real and more obvious, we saw a spike in bond yields in a number of countries, and Italy would be one example of that. Italian bond yields spiked significantly, and the reason for that is because Italy, coming into COVID-19, was an economy on the brink of recession, serious issues, seriously high levels of debt, and unfortunately, Italy has been at the really negative cutting edge of this crisis. If you see the news flow out of Italy, the north of Italy is effectively shut down at the moment, and massive loss of life and so on. So an economy like Italy looks very, very vulnerable. And indeed, it happened in most markets. In Ireland, bond yields went up about 60, 70 basis points as well. The European Central Bank stepped in last Wednesday night and introduced another package of quantitative easing, 750 billion. That has brought bond yields back down again. And this morning, bond yields have settled at lower levels, which I'll show you in a second. Sterling has weakened dramatically. Literally, in the space of about 3 weeks, sterling has gone from 82 pence to 92 pence against the euro. It has also weakened very significantly and dramatically against the dollar. And indeed, we've seen the dollar strengthen across the board, proving actually that the dollar still has a safe haven status in financial markets. It is hard to kind of figure why sterling has taken such a particular hit. Maybe it's because of the nonsense of Brexit. I think that's partly the case. I think it's also partly the case that Boris Johnson's government reacted very badly to COVID-19 at the beginning. They are now running faster and faster to stand still, and we've seen some amazing U-turns in how the UK is going to deal with this crisis over the last few days. But all of those factors, I think, are definitely leaning on sterling as a currency. Oil prices have absolutely collapsed. And two reasons for that. One is, obviously, if global economic activity is going to collapse, there'll be a lot less demand for oil. And you go out in the streets, even at the moment, and you see just how quiet they've become. So the demand for oil falling significantly. But there's also a bit of a spat going on between Saudi Arabia and the Russians. Prior to COVID-19, OPEC had been trying to has been for the last number of years restricting the supply of oil on world markets to keep prices up. The Saudi Arabians a few weeks back wanted to extend this supply curtailment agreement. The Russians refused to take part in that, and in retaliation, Saudi opened up the floodgates and swamped the world market with oil. And as a consequence, prices have collapsed. But then, as COVID-19, the economic impact of that on oil demand has started to build. We've seen them fall a lot further. So I think the only way you could describe the world of financial markets at the moment is one of absolute market mayhem. It is very much the common theme. So dramatic stuff happening on financial markets at the moment. This is what the sterling euro exchange rate. Outside on the extreme right hand side, you can see a pretty dramatic weakening of sterling against the euro over the last few weeks. Likewise here, the dollar against the euro, we've seen the dollar strengthened quite appreciably from about 112, 113 to around 106 this morning. So strong dollar. And that, as I say, is a reflection of the safe haven status that the dollar still has in global financial markets. Here we see the absolute dramatic decline in oil prices over the last few weeks. Oil was trading at $23, $24 a barrel this morning, having been trading between $60 and $65 a barrel for a prolonged period of time. So oil prices absolutely collapsing, and justifiably so. This is 10-year bond yields, and I put in 2 different dates. The 6th of March, this was at the early stages of COVID-19 before it really kicked in. And you can see, as I said, Ireland able to borrow at minus 0.2, the Germans at 0.73, the Italians just over 1%. And I have to say, a couple of weeks prior to that, the Italians were down at about 60, 70 basis points. And the notion that you would hand over money for 10 years to the Italian or the Greek governments and accept a return of just over 1%, frankly, made no sense to me whatsoever. And it was an indication of the very artificial nature of financial markets because of quantitative easing that has been happening over the last number of years. At the close of business on Friday, you can see the equivalent bond yields, Irish yields, have gone up to 0.24. But 2 days prior to that, those bond yields had all been higher, and the European Central Bank stepping in to get bond yields down by announcing a new package of quantitative easing has certainly brought bond yields back down. And as I say, this morning, they're one of the few financial markets where there is a sense of calm at the minute. This is global equity markets, and I suppose it is important to note that coming into COVID-19, global equity markets had been on an 11-year-old extraordinary bull run. Between March 2009 and the end of 2019, the US S&P up 378%, the FTSE 115%, the German DAX 261%, the Nikkei 242%, the Irish market 281%. You can see there that Brexit certainly had an impact on the UK market. But notwithstanding that, it was an 11-year period of extraordinary gains for equity markets. And here too, there was an element of artificiality. Quantitative easing had injected so much liquidity into markets in recent years that it was all, at least a lot of it, was finding its way back into equity markets because investors had nothing else to do with money. And we also had massive share buybacks by a lot of corporations around the world. So, coming into 2020, equity markets had done extraordinary things. They did look vulnerable, but we had no idea what would turn that vulnerability into something much more significant. And obviously, in the last few weeks, that has materialized in the shape of COVID-19. And between the 1st of January and the close of business last Friday, the S&P down 25%, the FTSE down almost 37%, the German market down 32.3%, the Japanese market down 28%, and the ISEC down 40%. So that is a pretty calamitous collapse in equity markets. And the real problem at the moment is that there is no visibility. There's no reason to suggest that equity markets should stop declining at this stage. There was a bit of a lift on Friday following some central bank interventions over the previous couple of days. But, this morning and indeed late Friday night and in Asia yesterday, those downward trends in markets have recommenced. And as I say, it is very difficult at the moment to suggest that markets are not going to fall any further. So it's just market mayhem out there at the moment. And, obviously, it is going to, those sorts of share price declines impact on the health of companies, but also a lot of personal wealth tied up in equity markets, particularly in pensions. And when you get that sort of calamitous decline, you have a very negative consumer wealth effect, because on paper, there's a lot of people a hell of a lot poorer today than they were 3 or 4 weeks ago. So once shops start to reopen again, you will definitely have a negative consumer wealth effect legacy, which could last for some time. In relation to Brexit, just to reiterate where we are on Brexit, because it's still a big issue. Britain left the European Union on the 31st of January, and in early March, the negotiations on the future trading relationship between the EU and the UK commenced. The UK adopted a very hardline stance coming into that. Important to understand that when Britain left on the 31st of January, the following morning, it was no longer a member of the European Union nominally, but there was a transition period in place which was due to expire on the 31st of December this year. And during that transition period, Britain would not be a member of the European Union, but Britain would continue to trade freely with the EU countries. So in a sense, it was a sense of status quo. And during that transition period, the UK and the European Union would seek to negotiate a future trading arrangement. The problem the whole time was that a 9 or 10 month period to negotiate a free trade agreement was a barmy idea. There's no way you could actually agree a trade deal in that short time frame. But the UK was insisting that whether or not a trade deal is done, they were going to exit the transition mechanism on the 31st of December. And the following morning, in the event of no trade deal, World Trade Organization trade tariffs would apply. And that would be the hard Brexit. And that certainly had not gone away. And I was absolutely astounded on the day of the Irish general election on February 8th, in the exit polls coming out of the election booths, just 1% of people cited Brexit as an issue. Believe me, Brexit was still an incredibly uncertain process. COVID-19 should definitely postpone Brexit. There's no doubt whatsoever about that in my mind. But as late as Friday, Dominic Raab, Boris Johnson were still saying that Britain will exit the transition mechanism on the 31st of December this year. That flies in the face of logic, but there's not a lot of logic obvious in the UK at the moment, particularly with Boris. I strongly suspect that will have to be revisited, and Britain will have to apply for an extension, because apart from the economic damage to the UK that's been done by COVID-19, there's also the question, how realistically could you expect UK and EU people to sit down remotely, albeit, and try and negotiate a trade deal when the world around them is falling apart because of because of COVID-19. So, it makes no sense whatsoever. So, watch this space. But the more I see about the political pronouncements from the UK, frankly, the more baffled I become. This is, I suppose, another important issue coming into COVID-19. This is the level of government debt expressed as a percentage of GDP at the end of last year, or close to the end of 2019. Euro area 86.4%, France 99%, Italy 138%, Spain 99%, Greece 180%, and so on down the line. What do those numbers mean? Well, to put a bit of context on them, a debt to GDP ratio of 60% is deemed sustainable, and it was one of the Maastricht convergence criteria targets back in 1999. So if you accept that 60% is a manageable level of government debt, between 60 and 100 it is starting to get dangerously high, and then a debt level above 100, creates a major financial vulnerability for countries involved. So, in the case of Italy, for example, the fact that Italian bond yields spiked last week is largely down to the fact that Italy has a huge debt level, likewise with Greece. So a lot of countries out there with a lot of government debt coming into this. And that is a problem in terms of the reaction to COVID-19, because there's a lot of talk, and I'll elaborate in a second, but there's a lot of talk about the need now for governments to open the purse and spend money, cut taxes, do whatever is necessary. But the problem is that coming into this crisis, the fiscal firepower available was already limited because of the legacy of government debt outstanding from the 2007-2008 great financial crash. So looking at the official response, the policy environment was poor pre-COVID. There's no doubt about that, because we've been living through a period of historically low interest rates. We've had massive programs of quantitative easing around the world in recent years. And in September 2018, for example, September 2019, I beg your pardon, the European Central Bank had turned on the tap again for quantitative easing. So there was a lot of monetary policy accommodation in the system pre-COVID-19. So, pumping a lot more money into the system, cutting interest rates further, what difference is that going to make in a real sense? I would draw the analogy of trying to push on a piece of string. There was certainly a limitation to what monetary policy could achieve from here, given how much of the monetary policy armor had already been used. And then if you look at the other policy, which is fiscal policy, that is government spending and taxation, that was definitely limited as well by the fact, as I just demonstrated, that a lot of countries had a lot of debt coming into this. So that had implications for the fiscal policy response as well. So what have we seen to date? Well, we've seen the Federal Reserve implement 2 emergency interest rate cuts over the last couple of weeks, and they have taken official interest rates down to 0. I remember thinking when the first emergency rate cut was implemented the week before last, that was the first emergency rate cut in the United States since the collapse of Lehman Brothers in September 2008. So that was a real indication of just how seriously the Federal Reserve was starting to realize this COVID-19 problem is. The Federal Reserve has also committed to supplying massive liquidity through quantitative easing into the financial system. Trump is about to announce the details of a $1 trillion fiscal package, tax cuts, expenditure increases. The Bank of England has cut rates from 0.75% to 0.1% last week. The UK government has announced a massive fiscal stimulus package. The European Central Bank last Wednesday night announced another package of quantitative easing of €750 billion by the end of this year extra. So that means in 2020, the European Central Bank will spend more than 1 trillion in QE. The EU's fiscal rules will have to be forgotten. Governments will have to be allowed to spend more money. Governments will have to be allowed to cut taxes. Governments will have to be allowed to run budget deficits significantly in excess of 3%. Every EU government will have to respond with massive fiscal package. And we've already seen the German government over the last 24 hours come out with an announcement of a major package. There are still serious sovereign risk issues, and I've highlighted Italy. So to me, what now needs to happen, and I noticed in the Financial Times this morning, there was a letter written by a few hundred academic economists, and Aidan Regan in UCD in Belfield was, I think, the instigator of this letter. But they're basically calling for the creation of a Eurobond market. A Eurobond market would basically mean that governments who needed to borrow money to fund fiscal expansion packages to deal with COVID-19 would not have to issue bonds themselves, because if they did, sovereign risk issues would come to the fore. So, for example, the Italians would be forced to pay significantly higher rates because they're already a serious sovereign risk. So under a Eurobond suggestion, as I understand it, as I would explain it, the European institutions, they borrow the money. So no individual country borrows the money, and the EU institution then distributes that money to the countries that need that money. So in other words, the Europe as a whole would be able to borrow at significantly lower interest rates than individual countries like Italy, Ireland, Spain, Greece, whatever. So I think it's essential, but I believed it was essential 10 years ago at the time of the great financial crisis, and it was not implemented. But I really think we need to move on and get real about that, because if we do not, if there's not massive fiscal expansion, if there's not the creation of a euro bond market, a eurozone crisis could become very quickly a real possibility again. Looking at the Irish economy, and I'm approaching the end now, so I'm going to run through Ireland pretty quickly. Ireland coming into this, unlike the euro area, for example, and indeed unlike the global economy, was in a pretty decent place. The momentum of the economy, although exaggerated by the activities of multinationals, was still pretty decent coming into this. We had an unemployment rate of 4.8% of the labour force. We created an extra 79, almost 80,000 jobs last year. Tourism, a very strong year. Consumer confidence was fragile as a result of Brexit, but once we avoided a hard Brexit, consumer confidence in the last 3 months picked up strongly. Business sentiment also quite cautious last year because of Brexit. But all in all, Ireland was doing well pre-COVID-19. In class, I took you through this issue. For those of you who are my students, GDP is the blue line, which is the international norm for measuring economic activity. In Ireland's case, because of aircraft leasing and because of intellectual property asset transfers, it is grossly exaggerated. And that brown line there, the modified gross national income, is a more realistic assessment of where the Irish economy is. So Ireland is an economy has been doing reasonably well, but not anything like as well as the GDP numbers would suggest. This is a breakdown of Irish GDP in 2019, the percentage changes. I suppose one thing that stands out there is the last two rows, if you look at fourth from the bottom, gross domestic product, 339 billion. And if you strip out all of that artificial stuff, you're left with modified domestic demand. This is the real economy of about 180 billion. So that's important. This is what's been happening on the consumer confidence front. COVID-19 is going to blow consumer confidence out of the water. Have no doubt about it. Over the next 2 or 3 months, consumer confidence is going to absolutely collapse. 10.8 million visitors into the country last year, a record year. Tourism contributes about 9.5 billion to the Irish economy, is going to be wiped out this year. There's no doubt about that. So looking at the economic impact, this certainly is not rocket science. Irish economic activity has effectively ground to a standstill over the last 2 weeks. The hospitality sector decimated, tourism decimated, the non-grocery retail sector has been decimated. So the overall economic impact, very, very stark. And if you think about it, there's over 310,000 working in retail, about 50,000 of those in the grocery side. So they'll be obviously okay, but the rest of retail employment will be wiped. Accommodation, food services, almost 180,000 people. Most of that has already been wiped. The banks will have to be incredibly supportive of business and households. A massive fiscal stimulus package is essential. In my view, the key priority, it's here and every place else, is to make sure that the businesses that were viable prior to this crisis will need to be viable coming out of this crisis. Because if we're going to rebuild our economy, and this applies across the world, we will need to have functioning businesses in place. So I think the real priority has got to be to offer as much financial subsidization as necessary to businesses to make sure that once the virus passes, that they can recommence business, can recommence hiring as quickly as possible. Because if you do not have functioning businesses, you will not be able to recreate a functioning economy again. So what can be done? Well, the banks obviously have to be very, very accommodative. We're seeing an agreement to obviate the needs for debt repayment for a 3-month period. We're going to see the banks ploughing more working capital into business. I think the revenue commissioners will have to give businesses holidays on VAT repayments and PAYE, PRSI. So a lot of support will have to be given to business to make sure we come out the other end of this. So finally, the longer term impact of this, I think the political fallout will be an analysis of who did well and who did less well. And you'd have to think at this juncture, you know, Boris is up there as one who has not done well to date. That can obviously change. So, you know, there will be a political legacy. There will be a massive government debt legacy on top of the already high levels of debt we had coming in. The growth of economic nationalism, tighter borders. As I mentioned earlier, the model of capitalism is now under serious threat and will have to be seriously looked at again. I think food security and safety will become a huge, huge issue. And, you know, the notion that you have food traveling across the world to countries, in my view, it never made sense anyway, but makes a lot less sense now. So I think there will be a refocusing on food security and safety. And indeed, there was an article in The Guardian yesterday showing that the dire situation food security is in the United Kingdom at the moment. And I also think actually businesses will be fundamentally reevaluating their supply chains, you know, where they're sourcing material from, what kind of vulnerability that creates in the event of borders shutting down, which is what we're seeing at the moment. And I think finally, and very importantly, it is absolutely essential that policymakers move as quickly as possible to prevent this economic crisis from morphing into a banking crisis. If it evolves into a banking crisis like 2007, 2008, the economic implications of this will be much, much more serious and will last for a lot longer. So at this stage, I would be delighted to hand over to Daniel and to take any questions you might have.
Hello, thank you very much, Jim. We'll just open up the chat room here. So, Jim, this question is from Yassine. He said, thank you very much for the presentation. He said, how can we ensure that the quantitative easing measures impact the economy and not find their way to the equity market without boosting the global economy?
Okay, I mean, the way quantitative easing has to work in this situation is that basically quantitative easing is the central banks buying government bonds from the banking system and injecting liquidity into the banking system. I think the global banking system needs to be leaned on in every country by the political system to make sure that the banks use this liquidity to continue to provide credit to companies, to continue to support companies. So, you know, banks will have to be forced, if they're not willing to do so voluntarily, to use this liquidity to actually support businesses. Because at the end of the day, all of that money finding its way into equity markets would have no impact. The only thing that will cause equity markets to bounce from this is when there are clear signs that the virus is passing and that more normal economic life will be resuming. But there is a challenge there. I totally take the point.
Thank you, Jim. The next question comes in from Ashveria. She also says, thank you. She's asking, she said, you said the European institutions borrow money and distribute to the countries in need. Who do they borrow the money from? Is it the government?
Okay, so it's for example, you know, I'm not quite sure, but the European Commission, for example, issues bonds on behalf of Europe. So that would mean that sovereign countries are no longer borrowing. Europe is borrowing as a whole, and as a consequence, you know, like the United States, there'd be less sovereign risk involved. So Europe as a body would be able to borrow more cheaply. Where would it borrow? Well, there is a big government bond market investment community out there. You know, there's still a lot of debt, but central banks would also fund some of that debt. Central banks would be buying some of those bonds as well as individual investors. And I suppose actually in a time of such crisis at the moment, probably central banks, by creating liquidity, a lot of that would have to find its way into the European bond market.
Okay, thank you. Next question here from Eamon. Just wondering, with the tightening of borders, where do you see the role of unmanned or very low manned modes of transport of goods where people locally pack and unpack, e.g. freight trains?
Yeah, I mean, I think if you look within Europe, for example, I mean, the single European market is about the free movement of goods and people. That's what it's all about. And clearly, there is a reluctance to have the free movement of people at the moment. So that is impacting on the free movement of goods. I think, borders will have to be opened up. They will have to ensure that the closure of borders does not prevent the movement of goods across borders. Because if that actually happens, I mean, the whole single European market in Europe becomes a waste of time and a nonsense. So it's up to the European Commission to make sure that every member country abides by its obligations in terms of the free movement of goods. Obviously, countries will do what they have to do to prevent the free movement of people at the moment. But you would really hope that a lot of the curtailment of free movement of people will be voluntary. People will not be traveling anyway. We've got to ensure that goods continue to flow across borders. And if we get borders shutting down, well, then the whole single European market falls down, and suddenly you're in a much, much deeper crisis, I think.
Thank you, Jim. Next question from Ken Power. What does Jim think about the UK's proposal to pay 80% of people that have lost their jobs? How will the UK be able to fund this? Should Ireland follow in a similar way?
Okay, there's two sort of issues here. If you look at sort of both sides of the economy at the moment, people are suffering because they're losing their jobs. Businesses are suffering because they're losing their business. And government has to address both of those issues in every country. As I said in my presentation, I believe businesses need to be given whatever financial support is required to make sure they remain viable once this crisis ends, and that they can recommence business and start hiring people again. But in the meanwhile, people who lose their jobs because of this will have to be financially supported by government. And the UK, has made the pledge on 80%. You'll see the Irish government over the next day or two elaborating further on what it's going to do. All governments are going to have to do this. And it's an extraordinary thing to say, but these are extraordinary times. This is unprecedented stuff. There's no doubt about that. So governments will have to be allowed to run significantly bigger fiscal deficits. The longer term issue about how you deal with those deficits, I think that will have to remain a longer term concern, because the immediacy of what we need to do at the moment to keep households and businesses alive is absolutely essential. This is totally unorthodox stuff, but I think you've got to recognize and appreciate the unorthodox and dramatic and unprecedented nature of what we're going through at the moment.
Okay, thank you, Jim. The next question comes in from Aisling Murphy. She says, very informative presentation, Jim, thank you. We have seen a massive shift in terms of office-based workers moving to working from home and virtual activity. Do you see a fundamental change in how we do business post this crisis, such as less office space being used?
Well, I suppose as somebody, I've worked from home for 10 years, so it's nothing new to me. But I mean, a lot of people are working at home at the moment. They're working at the kitchen table with kids in the background. So I think we are light years away from creating a remote working environment. So no, I mean, I think we come out the other end of this a lot of people who are working from home at the moment will return to their offices. So I don't see a seismic shift here, although, I would have argued in the past that we are definitely moving more and more towards the benefits of remote working, and this was driven by environmental issues more than anything else, and quality of life issues indeed. So there are certain people who it suits to work from home, suits me. So as a consequence, I am not contributing to rush hour traffic and environmental damage. My quality of life is better. I'm not spending hours sitting in traffic. So all of that stuff is still very real. But for most businesses, I think they will continue to operate from offices. So I think we're a long way away from that sort of seismic change.
Okay, thank you, Jim. It was a good question. Next question from Subhajit Ghosh. Thank you for the presentation, Jim. What difference do you anticipate between the recovery made by the market in 2008, 2009, and now after the COVID-19? The problem in 2008, 2009 was that the banks were getting busted, but now the situation is different.
Yeah, I mean, what made 2007 8 so bad and so prolonged with such a negative legacy was the fact that the recession was concentrated on the banking system. And I remember in a lecture saying that IMF research has shown that when a recession is caused by a shock to the financial system, it tends to be deeper and takes longer to eradicate than a recession that's caused by a shock to something else, such as the dot-com bubble bursting back in the early 2000s. This is very much an event-driven recession, and that event is COVID-19. So I think it's essential. So it is an economic crisis at the moment, and it is so essential that policymakers act aggressively to prevent this economic shock from morphing into a banking shock. Because if it does, you are not going to get that sort of V-shaped recovery that I still think is possible eventually. It becomes a much more sort of L-shaped recovery. In other words, you go through a number of years of pretty stagnant economic activity again. So policymakers have got to recognize the risks involved here. They've got to prevent it from hitting the banking system.
Perfect. Thank you, Jim. I'm not sure how much time now, Jim, you have for questions, but I'll keep going through them.
I'll stay here for the day, Daniel. I have no problem. It's the participants I worry about.
Okay, fair enough. Jim, this comes in from Jeff Power. Jim, thanks for the insightful presentation. Do you think this scenario will have a big influence on the housing or rental sector in Ireland? Naturally, if it is sustained for a long period, it will, but if it lasts 6 months, do you think it will impact it a lot with the demand still high?
Well, if you look back at the 2007-2008 crash here in Ireland, Ireland was hit particularly bad by that crash. So we got massive outward migration from the country, okay? And that took a lot of pressure off the housing market. This time round, we're going to get a deep recession here in Ireland, but we're going to get a deep recession everywhere. So there's not a huge incentive for Irish people to up sticks and go someplace else now, because every place else is going to be suffering through this. So I think when we come out the other end of this, when we recreate our functioning economy, as will everybody else, that fundamental demand for housing and rental market will be as significant as it was prior to this crash. So as a consequence of this, I think we cannot allow this shock allow us to be distracted from the imperative of continuing to deliver a lot more houses into both the owner-occupier and rental markets in Ireland. I would see this as from the point of view of building houses, this should be no more than a temporary distraction. That fundamental demand for housing here will re-emerge once this passes.
Okay, thank you, Jim. Next question from Brian Byrne. Thanks for the great presentation, Jim. There are some commentators that advise of dishing out money directly to citizen bank accounts without the middleman, such as done in Hong Kong. This negates the interest component that the bank would charge and is maybe more immediate than QE. Is this something that should be considered in Ireland?
Well, in the first lesson of economics, I was talking to you about, economics really is the science that looks at how you allocate scarce resources to achieve the best possible outcome. And resources are scarce at the best of times. They're going to be particularly scarce now, given the pressure to spend more money. So what you described there is helicopter money. To me, actually, I don't think that is the best use of scarce resources. I think, to me, the most fundamental thing we need to do is to make sure that businesses are kept alive. Because at the end of this, it is businesses that are alive. They are the ones that will create the employment that will take people off the unemployment register again. So I think having businesses that will hire people has to be the priority. The social welfare system will look after those people who lose their jobs, and the details of that we'll get over the next day or two, what sort of payments will be made to people. And I suppose the third factor is that people are just not able to spend money anyway at the moment. So, why would you turn around and spend 4 billion injecting money into people's bank accounts if they're not going to be able to spend it anyway? So I think it could be part of the solution, but I think there are much, much bigger imperatives. And to me, as I say, two things we need to do: support the business, number one, and number two, make sure that the social welfare system supports those people who are out of work. So, in other words, in a nutshell, it wouldn't be top of my list of priorities.
Okay, thank you, Jim. Next question from Michael Donoghue. Great lecture, Jim. Thank you. Does the fact that the entire global economy is taking a hit change this situation from the 2008 crash, where segments and sectors were more adversely hit? If everything is suffering, is this easier to fix than when it's an unequal impact across sectors?
Yeah, I suppose if you look back at 2007, 2008, I showed you graphs back in lecture that the world economy basically fell off the cliff. But statistically, during that period, global economic growth did not look as calamitous as it felt in countries like the States, in Europe, in Ireland. And one of the reasons for that was that China and the emerging economies actually continued to grow throughout that crisis. So that made the overall global complexion look a little bit better. And I suppose you could say, in a sense, China was the default mechanism that kept the world economy alive during that crash. Whereas this time round, every place is going to be hit significantly with this. You'd hope China is starting to switch back on over the last few days. Factories are starting to come up and running again. Hopefully that will be sustained and that you don't get a second round of infections. But the fact that this is a global calamity suggests that there's going to have to be a very strong global response. So if there's no ifs or buts, no individual countries can actually object to what's being done. It has to be a strong global coordinated response. And I suppose the bigger the crisis is, the more geographically spread it is, the easier it is to deal with it from a political perspective.
Perfect, thanks. Next question from Sahil. Thank you for the session, Jim. As you mentioned about the V shape of the growth graph, will the right leg of it be proportionally sloped to the left leg?
No, I would expect the right side of the V will be a bit flatter. Because, for a year or two, once we come out of this, there will be a lot of fear, there will be a lot of caution, there will be a lot of nervousness. As I said, a lot of personal wealth will have been destroyed during this, and it will take time to recover from that. So, no, I think the recovery is likely to be flatter, and it could take 2 to 3 years to get global economic activity back to where it was prior to this crash.
Okay, next question from Sachiaki. Thanks, Jim. China would be the first one to come out of the COVID-19 crisis, as it appears. what should be the first few steps they should take to normalize the economy? Also, in a generic sense, as countries slowly come out of this humanitarian crisis, which are the first few crucial steps they should take to avoid a 2007/8 encore?
Well, I think I hope I've kind of covered that. To me, the essential thing to do is to provide businesses with support. You know, if you think about Irish tourism is made up of hotels, restaurants, and pubs primarily. And if those businesses are not around at the end of this, well, then we will not be able to rebuild our tourism industry here. And likewise in every country in the world. So I think the imperative has got to be to provide support to businesses. And that will come from governments and it will come from banks. And in turn, you know, central banks will input into the bank side through the provision of liquidity.
The next question from Subhajit Dasgupta. Thank you very much for the session, Jim. I was wondering what the implications would be if Mr. Johnson fails to sign the free trade agreement.
With the European Union?
I would take it that that's what he's asking, yes.
Yeah, I mean, as I said, I think Britain cannot conceivably exit the transition mechanism at the end of this year. There will not be a trade deal done. So I think, so I hate actually applying logic to Boris's behaviour. Always a dangerous thing to do. But logic, and I think the whole business environment in the UK will really be of the view that you cannot exit the transition mechanism at the end of this year and crash out without a trade deal. I think Britain will have to apply for a 2-year extension and then a trade deal, you know, negotiations get underway again.
Okay, next question from Ashfaria. The businesses which have now come to a standstill, what measures should those businesses take in order to make sure that they do well once the economy recovers?
Well, you would hope. I mean, the only thing. I mean, if you're a business and all your revenue suddenly disappears and you still have fixed costs, you're in serious trouble. So clearly, those businesses will have to get out there and get as much support as possible and make sure that whatever support is available to get them through this cash flow crisis will be availed of, because, you know, government is not going to come knocking on your door. Businesses will have to be proactive about this. You know, they will have to talk to their banks about getting a more lenient treatment. They will have to talk to government about getting various payments. And businesses should also ensure that they maintain a relationship with their laid off staff, you know, to make sure that that connection is maintained. So it's a question of being proactive, making sure you get what's possible to make sure that once this passes, that you can recommence business again.
Okay, Yassine has another question here. It's a good one. Do you see an alternative to the capitalism and to economies that are only based on growth?
Yeah, well, it's a fantastic question. We probably need 2 hours to discuss it. But, you know, at the end of the day, we really do need to, and I think actually prior to COVID-19 anyway, based on the whole climate change environmental agenda, we really did need to stand back and question if this rush for growth should be the mantra. I think people will recognize at the end of this, I hope they do, the importance of having good public services, particularly health. The importance of having a food supply chain that is secure and safe. And, you know, one of the big challenges obviously is this consumers just pushing for cheaper and cheaper foods incessantly over time, leading to serious problems in the standards of how food is produced. And, you know, BSE was caused by food safety standards failing. COVID-19, it would appear, was caused by food safety standards failing. So I think we will have to have a real refocus on how we manage our lives, to be honest. But will this happen? You know, I hope it does. But the obvious risk would be that, you know, once COVID-19 passes, that we revert to normal again and we get back to where we were. We can't do that. The world has fundamentally changed. I'd love to come in and give you a 2-hour lecture on that someday.
Well, we might hold you to that one, Jim. I think Yassine probably will. Question from Carla Brogan. Could you please comment on the expected effects of massive fiscal stimulus packages on the currency, devaluation or inflation, and interest rates?
Well, interest rates are going to have to remain at rock bottom levels for the foreseeable future. There's no doubt about that. Governments will have to, central banks will have to continue to provide liquidity through quantitative easing. Countries will have to run significantly bigger fiscal deficits for the foreseeable future to deal with this. There's an inevitability about that. And normally, in normal circumstances, if one country was behaving like this, you would expect their currency to collapse in value. But virtually every country in the world will be doing the same thing over the next couple of years in response to this. So it's impossible to say why one currency should be more vulnerable than another, other than to say, and I think we've seen this in the last 2 weeks with sterling, smaller country currencies will be more vulnerable to significant declines in valuation. You know, there's no doubt about that. So the dollar, the euro will be the primary currencies, and all of the smaller ones, you know, will suffer. I think there's no doubt about that.
Just an add-on to that question from Carla, Jim, is can you please elaborate on the dangers of a potential banking crisis between institutional investors pulling out of the equities market, presumably into cash, and the physical stimulus packages? Where is the risk?
Well, the risk is that banks will... okay, sorry, I'll try to think about this again. The risk would be that banks, there's an outflow of money from banks into safer assets. So if all the money found its way into, you know, US treasuries, for example, into the dollar. So if banks were faced with this situation where their customers were defaulting on loans, where the bank's capital base was being eroded by bad debts, you know, very quickly the banks could run out of liquidity. And once banks run out of liquidity, that then threatens to evolve into a solvency problem where basically banks become insolvent. And, you know, that was the case with Lehman Brothers, for example. So that is why it is so essential that central banks provide the liquidity to banks to make sure they continue to work with their clients, that we do not see a surge in bad debts, that banks do not, number one, have a liquidity problem, that number two, develops into a solvency problem. So we will require a functioning banking system during this crisis, and more importantly, at the end of this crisis. So, you know, in a sense, all of these very unorthodox policy responses we're talking about, will need to be put in place to deal with this, what a totally unorthodox, unprecedented economic situation. And the one thing you do not want at this stage are headlines about banks getting into financial difficulty, as was the case with Bear Stearns, Lehman Brothers, and so on back in 2007, 2008.
Okay, that's thank you very much. It was a very good question from Carla, but and she's just said thanks, Jim.
Less good than the answer, I think.
That's all the questions. I'd have one last question for you, maybe, Jim. That's all the questions in the chat box there, wrapped up. My last question for you is, what is your view on quantitative easing and the use of it? I guess from the first time it's been used up to now, just your general views. on quantitative?
I mean, quantitative easing is a bizarre policy response. Okay, it has created an incredibly artificial asset environment. You know, a lot of that liquidity found its way into equity markets, into property. It pushed bond yields down to ridiculous levels. So it created an incredibly artificial environment. And I suppose in many ways was setting us up to be hit with some shock. And that shock is now COVID-19. But on the other hand, if quantitative easing had not been in place over the last decade, the whole global economic backdrop could have been much, much more difficult. So I think it was a necessary policy environment to have in place. And it certainly kept liquidity flowing, kept economies alive, and otherwise the situation could have been much more difficult. It's not ideal, of course, but, you know, I said in, I think, the first or second lecture as well to my MBA class that the 2007-2008 and the decade that followed, you would have to go back to the 1930s to find, and the Great Depression, to find an economic and financial shock of similar magnitude. And that's why unorthodox policies like quantitative easing were necessary. And it's why now that we're hit with this new massive shock, that unorthodox policy measures will be even more necessary. Because the real issue here, of course, Daniel, is that as well as an economic and financial tragedy, this is it's a personal tragedy. It's a tragedy for humanity. You know, you look at the news flow out of Italy, it just brings it home to you just how absolutely dramatic what we're living through at the moment. So unprecedented times require unprecedented responses. There's no doubt about that. And governments, central banks, policymakers need to stand up to the plate.
That's probably, as the questions have all been done there in the chat room, Jim, it's probably a good way to wrap up the session on that note with the personal tragedies in Italy. From me and from all the class, everyone's just saying their thank yous here. Thank you very much for the time. I don't know how long that's been. It seemed pretty short to me anyways, but yeah, nearly 2:20. But thank you very much from us all, and it was great to see you and hear from you.
Okay, folks, and I just say the very best of luck in the remainder of your course, and if I can be of further assistance, please let me know, and most importantly, stay safe. So very best of luck. Thank you.